It's not just silver collapsing. If there was a major delivery failure by one of these banks in London, as an example, all of these banks are not just involved in bullion. They're involved in every single asset that could be traded across the globe. The systemic contagion of this would be catastrophic. I think the world is growing tired of the way that the West has been able to control the commodity complex for all of these years. And that's why I've always talked about the fact that the challengers in the BRICS nations, and you look at who are the ones buying all the gold and silver. Well, it's China, it's India, it's Saudi Arabia, it's Russia, and we know this. We don't know exactly how much they're buying because wasn't it Saudi Arabia and China that both got flagged by the IMF for not reporting what they were bringing in?
Just 1 week ago, the financial world was stunned. Gold smashed through $4,300 an ounce, setting a record that no one thought possible this soon. And silver, the forgotten metal, erupted past $54, its highest level in over a decade. But then, something strange happened. Within hours, both metals were hit by what Andy Schectman calls the most desperate manipulation in modern market history. He believes this wasn't a random correction or technical pullback. This was a coordinated strike, an emergency effort to knock prices down, restore confidence in paper assets, and keep the illusion alive a little longer. Because if gold and silver were allowed to keep running, it would expose what's really happening behind the scenes, a systemic breakdown in trust, supply, and credibility across the entire Western financial system. Schectman says bluntly, if even one major London bank fails to deliver on silver, the contagion won't stop there. It'll ripple through stocks, bonds, and currencies worldwide. The stage is set. The stakes are global, and according to Schectman, the next phase of this story could change everything we know about money.
Large quantities of silver are being transported out from exchange warehouses and sent to secondary silver vaults across the country, ensuring the daily silver needs of millions of industrial enterprises. At the same time, state-owned enterprises are taking advantage of the significant price pullback to actively purchase silver from international markets, ensuring the normal operation of the industrial system. China is intensifying reserves of various strategic resources and will absolutely not allow key mineral resources to flow out of the country, nor will ever compromise national interests to rescue a foreign company. Now, here's another thing. Eric Young, King Kong on Twitter, someone that I've been wanting to have you interview. I've interviewed him once before, and he's fantastic. He says, I was just told that a 150-ton lease, or 4.82 million ounces, actually was leased by the London Metals Exchange from the Shanghai metals market, and that it was done so at grotesquely high lease rates for a very large tonnage. This would signal that borrowers who are short of deliverable metal and are willing to pay up to bridge the near-term needs in London are doing it because things are of that dire of a situation where it could really start to spiral and contagion can take effect. So again, when you see someone at this level who's been right for a very long time, and I have nothing but the highest amount of respect for him, to me, the bottom line is that the theme that we've been talking about, the tight physical, the high lease rates, the cross-region scouring for bars, this is real and well reported. And if you see 150 million tons from Chinese state banks and via the Shanghai Gold Exchange delivered to London to quell this problem, it would go hand in hand with knocking the hell out of the price by the same players to make people think the market is overvalued, that it's at its peak like it was in 1980 and 2011. And look, letting the price go up as high as it did pulled in an awful lot of speculators. And a lot of them didn't own gold, they just owned paper. And so when you dump massive waves of futures contracts into this thinly traded market, a lot of them sold without even knowing. They got triggered out of their contracts, which drove the paper price down. And maybe that's when you had London come in and say, we need to buy this silver at a lower price. Maybe it was London who came in and bought that silver after they knocked it down. I don't know who did it and who bought it. But I do know is that, to me, the whole point was to scare people away from buying gold and silver. That's what it really feels like to me. And this wasn't just another random correction. To me, it's as much as it could be as big as helping keep the LBMA propped up to maintain their system. But if there really is that much of a shortage that we've been hearing about forever, this game can't last, and supplies will keep shrinking no matter what amount of paper selling comes into the market at inopportune hours. And so I think, again, yes, it's scary to see a market move like this, but the fact that it moved like this is what, to me, makes it not so scary. It just reeks of desperation by big players who have been caught in a game where no one ever stood for delivery, and a continual rotation of paper promises has been what has allowed the fixing of gold and silver by the West forever. And it is now being challenged. Not just gold and silver, all of the world's commodities are being bought. And when we see 21 days of backwardation, where the normal market is called contango, where the price is for the future, or the spot contract is lower than the futures contract. When you go out into time, you have the cost of storage and interest and the time value cost of money. That's normal market. Backwardation says, I don't really want to trust you next month or the month after. I want it now, and I'm actually going to pay more for it right here today than I will out into the future, because I really don't trust the future. And to see that in silver is really unusual. And for as long as we did, and as much as $3, now it's narrowed. But what I'm saying is that is really very bullish. And when you see this kind of desperation knock the hell out of the price and then gobble silver up to where it goes green in 20 minutes, someone came in and bought physical, and maybe that was the trade. Maybe what Eric Young is saying happened right then and there, that China leased the gold at that level, sold the gold. I mean, I think it all boils down to a breakdown in confidence in the dollar, Michelle, as a reliable store of value. It's like a melting ice cube. The trust in the dollar, the trust in things like the Bureau of Labor Statistics or the CFTC. The CFTC, if you ask most people who were watching the JP Morgan trial when they did pay a $920 million fine to the Justice Department for spoofing, that it should have been RICO charges, that it should have been much more severe than it was, that the CFTC hasn't done anything to protect the gold and silver market. Trust in the dollar, trust in our institutions, trust in everything is fueling. This is what has been fueling higher commodity prices, tighter credit spreads. Real assets like gold and silver are stepping in to capture what the dollar and the loss of trust is losing. And I think when trust in the dollar starts to slip, and in our institutions and in our reporting of the facts and of reality, people move into real assets like gold and silver. This isn't about price increase in gold that we've been seeing for the past 9 straight weeks. It's about a revaluation of all fiat currencies by gold. And I think that that's really what is happening. And I think it started to arguably start to make people nervous that things needed to I think calm down a little bit. And people are most affected by price. It is the greatest tool of misdirection. They don't look underneath the hood. They just see the price and they listen to the nonsense media. And shame on all of these media talking head geniuses who, on one hand, from an economic perspective or from a market and analytical perspective, are correct. But ignoring how it was achieved is ignoring the most important part of the story. And I think it renders what they're saying moot.
Andy Schectman points to a series of developments that connect perfectly, like puzzle pieces forming a crisis picture. First, massive silver withdrawals. Across U.S. and London exchanges, physical inventories have been vanishing, millions of ounces transferred from exchange vaults to private storage. This isn't investors speculating, it's industrial buyers and sovereign entities locking up what's left before supply disappears. Second, China's stealth accumulation. While Western media screamed bubble, Chinese state-owned companies were quietly buying up silver at fire sale prices. Beijing even authorized the leasing of 150 tons of silver, about 4.8 million ounces, from Shanghai to London at grotesquely high lease rates. Why? Because Western markets were short on physical metal. They needed a lifeline. That, Schectman says, is the clearest proof yet that the paper system is cracking. Third, the illusion of price. When gold hit $4,300 and silver touched $54, the COMEX and LBMA didn't celebrate a bull market. They panicked. Massive sell orders flooded in during the thinnest hours of trading, driving silver under $50 and gold down by over $200 in minutes. That wasn't selling pressure. That was damage control. Schectman calls it the oldest trick in the book. Smash the paper price, scare retail investors, then quietly scoop up physical metal at a discount. But this time, it backfired. Within hours, silver bounced back into the green. Gold recovered half its losses. Physical dealers reported record weekend demand, and beneath it all, a new signal appeared: 21 straight days of backwardation in silver. That means people are willing to pay more for silver today than months in the future, because they don't trust anyone to deliver it later. That's historic. That's panic buying by professionals who know the system is close to breaking. Fourth, the flight from paper. Foreign holdings of U.S. Treasuries have dropped from nearly half a decade ago to just 31% today. Central banks aren't buying promises anymore. They're buying gold, and now even silver. Saudi Arabia's central bank just purchased tens of millions in SLV, giving them rights to take physical delivery. Schectman connects the dots. The East is hoarding real metal. The West is defending paper illusions. And the world is waking up to the truth that fiat currencies are melting ice cubes. He says this isn't a speculative bubble. It's the monetary reset we've been warned about for years. Gold and silver aren't rising. Currencies are collapsing.
You're watching massive stress in London. There are reports that there's genuine stress for silver, lack of silver in China, that the supply chain has completely been dried. For the first time in 50 plus years, central banks not only are buying gold, they're buying silver too. We saw Saudi central bank purchase almost 30 million worth of SLV in August. As much as I almost choke on saying that, SLV, the amount that they bought would allow them to take possession. And then you get reports that foreign investors now hold a higher amount of gold than U.S. Treasuries. In fact, the share of U.S. Treasuries, they were saying, was down by foreign investors from 49% to 31% today. 49% in 2013 or 2012, somewhere in that neighborhood. But in other words, at the same time all of this stuff is happening, you're beginning to see real stress within the banking system, where we've seen these two big the auto supply and the other company, I think it was called Tricolor subprime auto lender, and you know the private equity in dealing with some prime auto lenders. This company just went belly up and is tied to the regional banks. And so, I think that ultimately the markets will have their way. But again, you have a lot of very big players who are on the wrong side of this, massively short. Bob Goldman was talking the other day of the managed money being short 1 billion ounces of silver. In essence, and that's massive. It's huge. So that means that there are other players on the other side of that would benefit from it. But when you have that kind of volume on a system that is rehypothecating and trading contracts, where, for example, you look at David Jensen, who's going to come on our show. He talks about 140 million ounce float in London that's trading 600 million ounces a day in deliverable contracts, with as much as 2 billion ounces in contracts out there that could stand for delivery with only 140 million ounce float. Now, what could possibly go wrong? What could possibly go wrong? And maybe that's why Eric Young is saying that the LBMA reached out to China and said, we'll take it at these obscene rates. We need it now. We need it. And we'll pay the high lease rates because of that. Because when you play a game, and look, it's not just silver collapsing. If there was a major delivery failure by one of these banks in London, as an example, all of these banks are not just involved in bullion. They're involved in every single asset that could be traded across the globe. The systemic contagion of this would be catastrophic. It would bring down some of the biggest banks in the world. And this starts to move towards what Tom Luongo talks about, on a coordinated attack against the Bank of England and the European aristocrats. And I don't know that to be true. Tom believes it. But all I can simply tell you is that, to me, the fact that it was done the way that it is done, and then you had someone come in and scoop things up, pushing silver right back up into the positive territory tells me it was coordinated. It was coordinated by players, perhaps, to drive the paper price down, to accumulate physical at much lower rates to make good on short contracts that were getting very close to, creating this huge squeeze that everyone has been waiting for forever. Could it be that? Yeah, why not? Sure, there is some legitimacy to profit taking, to, look, it's gone up too far too fast, and technicals say you should take profit. Some of that is true, and I believe that to be true. But that's cover for a bigger story as far as I'm concerned. And I think that's really what I take away from all of this, honestly. And I think it's hard to ignore it any other way.
Right now, gold sits around $4,095.66, and silver just under $50, both slightly below last week's highs. But Schectman insists this pullback is the calm before the storm. When the next wave hits, when delivery failures finally happen, the paper markets won't just break. They'll vanish. At that point, the world will rediscover what real value means. So, here's the question for you. Do you believe gold and silver just experienced a normal correction, or was this the last-ditch defense of a dying paper system? If the East is accumulating real metal while the West prints promises, which side of history will you stand on? And when the reset arrives, will you be holding paper wealth or real money? Drop your thoughts below. I genuinely want to hear your view. If this video helped you understand what's happening behind the curtain, hit like, subscribe, and turn on notifications so you never miss a major macro edge breakdown. The next phase could move faster than anyone expects, and those who understand the game now will be the ones still standing when the smoke clears. Stay informed, stay grounded, and remember, real wealth is what you can hold in your hand when trust is gone.